Welcome back to Wall Street Silver. We have some amazing guests with us today. Mr. Andy Schectman from Miles Franklin, I'm sorry, sir. And Bill Holter. Thank you for joining me, gentlemen.
Good to be back, Jimmy. Good to see you.
So today is an amazing day. Today is an amazing day, or a day which shall live in infamy. We have 50 years ago today, or Nixon took us off the gold standard in a temporary move that has gone on for 50 years. And Andy, you were a young man back during those days, or you were just born in 71, weren't you?
70, yeah.
Yeah.
70.
So this was before our time, really, but you're an expert on the metals market, the gold market. What does this mean to you, this 50-year anniversary when our money actually changed?
If you go back to the beginning, really, of currencies, or at least dominant world currencies, to the 1400s, there's been about a half a dozen or so currencies that have been considered, world reserve, for lack of a better definition. And in every single example, 50 years is typically the lifespan. They range between 40 and 50 years for fiat, non-backed currencies. And if you realize that the tie to gold was severed basically 50 years ago to the day, we are now living on borrowed time. And so, in a bigger picture, it was going back against our word, breaking our promise to the world. And we have been given, I think, probably, or we're living, or have been living, on borrowed time for quite some time, based upon just the flat out mismanagement of the world reserve currency. So I would say to you that the chances are, whether it be SDRs, which you're hearing more and more about, the release of SDRs that just came about the other day from the International Monetary Fund, or perhaps a currency that arises from the BRICS nations, whatever it is, I think there will be a challenger to challenge the dollar for singular world reserve status. And when you realize we're at the end of what history has told us is the length of any world reserve run, I think that this is a very important topic, and one that people should understand. If it happens, if the dollar loses its single world reserve status, with that comes a kind of an awakening, I think, maybe even a spiritual moment for this country, when you realize that our standard of living, for the most part, has been fostered by the good grace of our creditors. And I think when you see that chart right there, when you realize that the dollar has lost since 1971 so much of its purchasing power, 90% of it, I think it's really very, very significant and very real. And I think the world would embrace a currency that is managed a little bit better, and maybe even backed by something that would not allow the politicians to do what they have since the beginning of time, and that is choose the printing press over austerity and tough decisions. So I think it's a big deal, Jimmy.
Well, this chart really says it all. And it didn't really start with Nixon taking us off the gold standard in 71. Really, it started back at the end of World War II, and us growing our military empire. That's an expensive process to go through, to fight the Korean War, the Vietnam War, the Great Society, social spending. All these things are expensive, and having a currency that is linked to a gold standard enforces financial discipline, and all of those things led up to that point of Nixon taking us off the gold standard. What does that mean to you, Mr. Holter?
If you look at that chart, it goes back to the beginning where the Fed was created. Dollars were to a bank, and if you had gold, you could get dollars. If you had dollars, you could get gold. That was broken in 1933 or 1934, and they had to revalue gold from $20.67 to $35. So that was a devaluation of the dollar, because from 1913 to 1933, they had overissued dollars versus the gold that they actually had. So they had to devalue the dollar in 1933. Then you had after World War II in the 1950s and 60s, they started with the social spending. We had the Korean War, the Vietnam War, and that's when Nixon took us off the gold standard. And he had to do that because foreign countries, and only central banks were allowed to do this, and in particular France, de Gaulle was presenting dollars and saying, we want $35 an ounce gold. Well, we bled down from over 20,000 tons of gold down to where we supposedly are now, just over 8,000 tons of gold. So basically what you've seen after that is another huge devaluation. And at this point, we're at the end game. We're at the end game for the dollar. And as I mentioned before we started recording, in order to exit the casino with capital, you're going to have to exit with either gold or silver. I mean, you can hedge paper with paper, but it's still only paper. And what I'm getting at is, in order to actually get real wealth out of the system, once this thing blows up, the only way to get that wealth out of the system is to already have it out of the system and in gold or silver beforehand. This is going to be people are looking at this and saying, oh, well, the cost of goods are going up. The flip side of that is what you've saved all these years for your labor, for your for your life's work, that's going to be wiped out.
Mhm.
Your savings is going to be wiped out. So yeah, inflation on one hand is the cost of goods. The result is the cost of goods going up. But for those who have saved and have their money, like I said, in the casino, in paper, in dollars, their life's work is going to be blown up.
Yeah. You know, all these metrics since 1971, since we left the gold standard, have markedly worsened. Everything since 1971, whether all the key metrics that we measure life in, you know, the personal savings rate been gradually declining. Here's what it took to buy a house back in 1971. The average family, how long you had to work to have a home versus now. The hours you have to work to buy the S&P. Just every single metric in life for how we measure things since we left sound money have just gone the wrong direction. And I can't stress this enough. At some point, this all blows up, and I think we're sort of seeing the end stages of that. And this one really just drives it home. U.S. national debt. When you're on a sound money policy, that puts limits on what a government can spend. And once we left the gold standard, it's like all the handcuffs were off, right? They can just do whatever they want. Mr. Schectman?
Well, Jim, now we have modern monetary theory, so none of this really matters. I mean, we could just print as much money as we want and spend as much as we want.
You know, looking at that chart, it's interesting. At the end of Q1 2021, the national debt was about $30 trillion, 27, 28, right in that neighborhood. That doesn't take into account the unfunded liabilities of Medicare, Medicaid, Social Security, government, military pensions, et cetera, which by their own admission is in excess of $140 trillion. We talk about how big a trillion is. A trillion seconds was 31,688 years ago. The numbers are extraordinary. And when we talk about a country at its end game status or position, I was looking at the balance sheet of the US government, and do you guys know what the largest asset is according to the US government on their balance sheet right now, 2021?
Student debt. Student debt.
Student debt.
I saw your video with Travis. I already knew that answer.
1.3 or 4 or 5 trillion dollars represents 33% basically of all of the assets in the United States. The next is military, the next is land. So you take military, the bases and the bullets and the guns out, you take the student debt out, you got an asset base under $1 trillion in land and supposedly the gold that we have held at Fort Knox, supposedly hasn't been audited in, I don't know, 65 years or what have you. So when you talk about a system that is grossly indebted, has virtually nothing in the way of assets, has bled out its manufacturing base, who consumes more than it produces, and has interest rates that are in real terms negative. Travis, when I asked him, the economic ninja believes that they will move in nominal terms negative. They have no choice. At what point does the rest of the world say, we've had enough, that, we need something that has value? Because right now, the world is not being compensated properly for holding dollars that are losing value so precipitously. They tell us that CPI is running at 5.5%. John Williams, who only uses the metrics from 1980 under previous administrations before they were changed, says it's almost 3 times that.
Yeah.
So when you talk about moving backwards by, anywhere between 5 and 13% per year, we're getting closer to that end game moment, that crossing that Rubicon, that seminal moment. Pick your analogy any way you want, but it's very apropos that as things are getting as crazy as they are, that we are now at that 50-year mark.
Mr. Holter, take us back through the history. We had gold coming into this country for decades, up until World War II. And something happened at the end of World War II, let's call it the 50s. Looking at this graph, this is the US gold reserves. They just started dropping precipitously during this time frame. And then then Nixon took us off the gold standard in 1971, and that all came to a halt. But what caused all this? Why did we start losing our gold reserves?
Because we started to overprint dollars, and foreigners realized that they needed to hold gold rather than dollars because the dollars were more plentiful than the gold. I mean, it was basically anytime a currency is convertible into gold, because of what politicians do as far as overborrowing and overspending, that currency will be converted. If you offer convertibility, it will convert. And I want to touch on what Andy was talking about. If any nation ever could become prosperous through borrowing, there would never have been poverty. I mean, we would be living in a world of nothing but Skittles and unicorns. And that's the problem, is that over the last, since over the last 50 years, the reason we've had, call it a good life, not a struggling life, is because we borrowed from the future for today. And we've continued to do that. And that's what deficit spending is. You're spending more than what you produce. And when you spend more than you produce, you get stuff, and it's a good life until that bill comes due. And at this point, the bill is coming due. And I would suggest that the fact that interest rates, in order to carry this debt, have got to stay where they are or even go negative, that's proof positive that the bill's coming due.
Can we go back to 1971 to 1973, that period? I mean, I was a young boy at that time. I distinctly remember sitting in my mother's Volkswagen Beetle online waiting to get gas in 1973 during the shock. How much I know that there was conflict with Israel, and that was one of the things that they blamed for the embargo. But isn't it true that leading up to that, OPEC nations were getting killed with the US dollar and losing money?
Exactly. The dollar was declining in value, so they're producing, selling the oil, and then what they were receiving, dollars for the oil, was declining. And that's what led Kissinger to get the Saudis to accept only dollars, and that action alone firmed and strengthened the dollar. The selling in the dollar versus other currencies ceased, because at that point, really the only way to conduct business worldwide was through dollars. So what they did was they created a monopoly as far as for trade. They created a monopoly where you had to use dollars, and that created artificial demand. And that is, if you remember Richard Russell talking about the synthetic dollar short, that's what the synthetic dollar short was. It created artificial, but basically mandatory demand for the dollar. Yeah. And now you're seeing that unwind because there are alternatives. You've got Russia and China doing business in their own currencies. You've got the world doing more and more business now in other currencies other than the dollar.
All of this leads back to oil and gold. It's at the end of the day, people want hard assets, real commodities, as a foundation of the value of wealth. And gold seems to be, it's no matter what happens, no matter what governments seem to do with their fiat currencies, the market at some point will impose a gold standard again. I mean, it happened in 1980. The crisis forced Paul Volcker to raise interest rates to 20% just to reestablish confidence in the US dollar, because inflation was running out of control in the late 70s. But, here's the situation we're at. Inflation's beginning to take off in the United States. We're having our highest CPI and PPI readings in decades right now. And that's if you even take them seriously. A lot of us don't. It's probably much higher. The shadow stats numbers, as you said, are north of 10 or 12%, I believe, right now. What stops at this time, Andy? I don't think the Fed can raise rates to 20%. I don't think the Fed can raise rates to 4%. What stops at this time the inflation if CPI starts printing 10%? What do they do?
I don't know. I think we've already passed the point of no return. In 1980, when Volcker raised interest rates to 18, 20%, we didn't have the mountain of debt that we had. In fact, we probably had a surplus back then. So you cannot raise interest rates. You saw what happened in 2019. They talked about austerity and raising rates, and they did just a little bit, and the whole market threw up.
Yeah, what was it? I'm sorry to interrupt. It was 2.25% before they puked, right? And
I think they got all the way up to 3% for a moment, or real close to it, and maybe even breached it for a moment. And I had always believed that 3% was kind of the magic number that they would never get over. And they touched it and maybe briefly crossed it for a second, and it came right back down. There is no way that they can ever normalize their balance sheet, stop the stimulus, or try to rein things in. It's all just a bunch of lip service and nonsense when you've embarked upon a debt crusade the way that the US has. So I don't know if there's anything that can stop it at this point, Jimmy. I really don't.
Going back again to the 1970s, when all this happened under the Nixon administration, they were facing severe inflation. Nixon imposed some wage and price controls. There's been some talk about yield curve control. But where do you guys think we're heading as the market starts to unwind here? Do you think we're going to see wage and price controls? Do you think we're going to see yield curve control?
I think you're already seeing yield curve control myself. I don't know about wage and price, but yield for sure. I think you're already seeing it.
Mr. Holter?
If you dig into it, every and all markets are rigged and manipulated, and they're done with derivatives. Andy mentioning there's yield curve control now. What do you think the suppression of gold and silver pricing is? That's yield suppression. The reason being, gold is the direct competitor, or a direct competitor, to the dollar. So they have to show you that gold is bad, dollar is good. And why do they have to do that? Because they have to borrow so much money. And if people were running out of dollars and moving out of bonds, you'd have interest rates going higher. And they can't let interest rates go higher, because if they do, at this point, like Andy said, every 1% raise in interest rates is another 300 billion every year in debt service. I want to go back. I try to correct people on this. CPI and PPI is not inflation. The CPI and PPI are the results of inflation. The inflation, if you look up, if you find a dictionary that hasn't already been altered by the woke idiots in the world, if you find the dictionary and look up the definition, inflation is the increase of money supply. And in today's world, that means the increase in debt.
Yep.
So the inflation has already happened. They've already pumped that money and that credit into the system. So the inflation is there. All we're seeing now is the results of it.
You know, by the way, I just want to make a quick little analogy to when you guys burst on the scene at the beginning of February, January at the Silversqueeze, and what we saw this last Sunday. The exact same thing happened in the access market when you folks jumped on that Sunday night, and someone dumped 2 years worth of global mine supply, 1.5 billion ounces of silver onto the market that Sunday night, Monday morning, February 1st, to drive down the price. No one in their right mind would ever do that, just like no one in their right mind would ever buy treasuries earning negative yield. The same thing is true what happened Sunday night. $4 billion worth of gold dumped onto the market in the middle of the night between London close and New York open. That trader would be fired and or shot, maybe not in that order. And you can see what they're trying to do. They're panicking, and they have, I think now they're mugging people in broad daylight, just like this, because they're getting very, very close to that moment where people wake up and realize that these traditional assets like treasuries are certainly a sucker's game. And so what is the canary in the mine shaft? It's what's sitting behind you there, Jimmy, and it's also gold. And those two things need to be quieted by the big money. And I think people need to take a step back and realize that what we've seen in the manipulation of the gold market is 100% not real. In the past 3 days, we have not had one person sell an ounce of gold or silver. And in fact, it is the closest environment I've seen since that weekend when I was taking calls till 2 a.m. and working all night long. That first weekend that we were doing interviews on the live streams on your channel, the end of January, beginning of February, the banks are running scared. And if you're foolish enough to dump 2 million ounces of gold in the thinnest trading session in period when Japan and Singapore are on vacation, making it even more opportune to drive the price down and not maximize your return. In fact, the antithesis of that is guaranteed the lowest return possible or execution possible. We're getting close. And I just want people to understand that this is something that we don't see in real markets. And to get bummed out that the price got knocked down, you should be thrilled that you're able to buy it cheap as a subsidy, because those types of movements in the real market would never happen.
So final thoughts, we have 50th anniversary of Nixon taking us off the gold standard. Do you really think we're going back that way? Is the market going to force us back onto some sort of standard, some sort of tangible asset standard to a currency? Whether it's, I doubt it'll be silver. There's just not enough silver. But is there a scenario where we get forced back onto a standard by the market?
I think there is.
I
know Billy does, but look, why else would the Bank of International Settlements reclassify gold as the only other tier one? Why else would all the central banks have been accumulating it since 2017? Why else would the central banks have repatriated out of the Bank of England and the New York Fed? You hear all this rumbling of SDRs being issued by the International Monetary Fund, the same group that reclassified gold as a tier one reserve. If it's not on our own volition, then I think it would be, if I had to guess, at some point when the dollar is spiraling down this drain, the Chinese will come out and issue it gold backing, and it won't be convertible as Bill talked about, but it will be pegged, and the veracity of it would be denoted on a distributed ledger. Maybe the gold is held in Swiss vaults and audited by independent auditors, but the veracity, the number of ounces, would be denoted on a distributed ledger. And so whether it by hook or crook, I think ultimately you have to go back to sound money, because no one's going to drink the Kool-Aid ever again. And that's why you see cryptocurrencies. And I think indeed you will see, whether it come from the BRICS nations or from the West, my own opinion is that absolutely that's the whole reason in terms of long game that gold was reclassified.
Mr. Holter, you have the final word. We going back to a gold standard?
We believe there's going to be two resets. The first reset will be man-made. Very well could be SDRs as the settlement tool. There's no way to know. But the first reset, being man-made, will leave those who are in power still in power. It's not going to really change anything. Then you're going to have a Mother Nature reset, where the populace loses confidence in whatever, whatever the new paper is, and they begin to not accept the new paper. Then you're going to have Mother Nature doing a full-blown reset, where derivatives, which are used currently to price markets, will be worthless. What they've done since we went off the gold standard is we're now looking at the end game of the everything bubble. Andy mentioned that all assets, stocks, bonds, real estate, they've all gone to bubble levels, and they used to not be correlated. You'd have bonds going up when stocks were going down and vice versa. Now you have the everything bubble. And the problem with that is the everything bubble, everything is supported by credit. The whole system is supported by credit. And I've been adamant that this is going to be a credit event. When this is all over, people are going to look back and say, how could people have been so stupid as to think that you could build real economies on debt? The problem with that is, at some point in time, credit becomes impaired. And I would suggest it's already impaired because it's not payable. And interest rates can, under these circumstances, you can never have interest rates go higher, because what that'll do is that will pop the bubble, and everything's in a bubble. The viewers need to understand that gold, a gold coin, a silver coin, a bar, what have you, those are the only monies on the planet that are not liability money. When I say liability money, they're not someone else's promise. Like dollars are backed by the Fed and the full faith and credit of the US. Then you've got euros and yen. The bottom line is they're all created by, guaranteed by, and backed by a government. A gold coin or a silver coin, all that is proof. It's proof that labor, capital, and equipment have already been used to create that coin. They don't promise anything. The only thing they do is prove that actual labor, capital, and equipment has already been used. So in a world that is collapsing because credit is collapsing, you want something that has no liability. And the only two monies are gold and silver.
And on that happy note, thank you very much, gentlemen. Andy Schectman, Bill Holter. I appreciate it.
Thanks, Jimmy. Thanks, Lee. Good to see you, Billy.